Good morning, Sense of Things. It's Jeff and Ron once again with another episode of the Sense of Things podcast. And on today's show, it's going to be me driving the boat a little bit. And we're going to talk a little bit about the bond market, which we had on our 100th show. We went into depth about the bond market and what we saw going on there. We'll talk a little bit about some of the economics going on this week. We've gotten all the economics out of the way for the week, so we can analyze that and take a look at it. And I've got three things I want to cover there. We'll talk a little bit about where the S&P 500 is, and then talk about some green shoots overseas that I think are somewhat interesting that I read in an article this morning. So stay tuned. We'll be right back on in a second. Hello, everybody. Welcome to the show. Ron, how are you, my friend?
Good morning. Good. I know you got some good stuff today. We got to dovetail what we were talking about in our last show and last week. What do you got?
Let's jump off to the races here. Give me just a second to get the right thing up on the screen before I show everybody my entire screen, which is not good. All right, let's go over here to the bond market. If you remember a couple weeks ago, we were talking about the bond market, and we had seen this is Liberation Day right here. That was the day that the tariffs were announced. The bond market took off like a rocket ship over the next couple days. This is the iShares 10 to 20 year Treasury bond fund, which is, I think, probably the best proxy for the 10-year bond. And that's the majority of what's in there. Then all of a sudden, as we were talking about the last week, we saw this massive drop off here. And if you remember, what I talked about is my theory was that this was not just a bunch of countries selling US treasuries. I think my personal belief is this was a bunch of hedge funds delevering at the same time, because countries can't move this fast. So this is deleveraging, and what we saw is it bottomed out here mid last week or at the end of last week, and it's been steadying and getting better again, which I personally think we're into steady, stable mode. Unless something dramatic happens again, more than likely we're going to get back on our just ambling along over time mode. Ron, what are your thoughts on bonds and yields right now?
I got to tell you, the bond market, what do they say, is at least 5 times larger than the equity market.
Yep.
And all the sharks and the shysters are in that market, as we all know. I'm going to slightly disagree with you. I don't know. I agree with you that definitely there was some either risk management with the private equity and the hedge funds, but the three countries that could absolutely sell off and kill our bond market is China, Japan, and Russia.
Yeah, Canada is actually a big player in that too. And I know they were a big seller, but if you look at one of the things I always look at is the dollar index. And if you look at the dollar index, really since Trump started talking about tariffs, the dollar index has been going down. So that tells me that a lot of those countries were basically selling off treasuries over that time period and then putting them into their own currencies to pump their currencies up a little bit. But yeah, this is just such a dramatic move. And I don't see those countries. I could see China, maybe Russia colluding together. Japan hates them both. So I can't imagine that they got together and said, hey, let's all sell off treasuries at the same time.
I don't know the number anymore because the last time I heard it was about 6 months ago, and it was about the same it was 5 years ago, that Japan and China combined owned about 15% of our debt.
I can believe that.
I don't know if that's gone up about the same or gone down. Based on these numbers, I would say it's gone down.
Yeah, Japan is the largest holder of our debt out there. I could see them, just to make a point, dumping a little bit, but it hurts them in the long run, because if the dollar goes down, then they don't sell as much of their crap over here in those cases. And that's a large reason why a lot of times they buy our debt, is to keep the dollar strong so that we buy stuff on the inbound side.
That, and to them, it's also risk-free.
Sure. Absolutely. So it's interesting. Like I said, the good part is I think we've seen, hopefully, the last of the craziness in that market. It's supposed to be boring. Bond guys are the most boring people I've ever seen, but they're usually also the smartest guy in the room.
They also get the biggest commissions.
They do. Let's look at a couple economic things going on this week. We mentioned this on our previous show, so I wanted to let on with that. Jobless claims for this week. Now, the expectation was that they were going to stay about where they've been, about 225, and they actually came in at 215. So that's an interesting movement in the market, or at least in the jobless claims world, because we've been thinking that we're going to start to see creeping up of this because of paring down of government employment. But I don't know if people are getting hired into companies now, or government employers are getting hired. I don't know what it is, but it seems like it's moving in the, at least this iteration is moving in the right direction.
Yeah, I got to tell you, I can't figure out these jobless claims because every time you hear the analysts and the strategists giving their numbers, I don't think I've ever had anybody that was right on, and they're all using the same information.
Yeah.
And I love the ones that are so high over and so low that, and then it's right in the middle. I'm like, how do you still have your job?
Yeah. You look at the consensus range from 218 to 230. Now, I will say that this spread has tightened up quite a bit. I remember a
Yeah, a
couple
lot
years
better.
ago when my former co-host on this show, when he would do some of these things, and this was like in the midst of COVID, and the analysts and all this, or the economists, this might be like 115 to 400. Hey, I was right. Okay, yeah, but you could drive a truck through the middle of your estimates at this point. So
Yeah.
it has tightened up a little bit.
Even you and I could kick the football through those
Oh,
goalposts.
I know, exactly. We look at retail sales. This was a big one for this week. The consensus was 1.4. We came in at 1.4, but if you look at it from the prior month, it was 0.2%. So we saw a pretty big surge. Now, part of that was in cars. And I think some of that, the longer term buying of new cars and things like that, got thrown forward because everybody's concerned that tariffs are going to cause cars to double in price overnight or whatever. I get that, but you can't buy if you don't have money. So that says the consumer is still fighting it at this point,
Well,
although
don't forget, we
continue.
saw the online sales is
Yeah,
consistently going up.
it keeps rising. It's getting easier, or there's just no other alternative. I think of the Targets of the world. You go into Target and only a third of the stuff they actually sell is in the store at that point. So
Right.
it intrigues me. Housing starts and permits. This was a bit of a surprise this morning. Housing starts down to 1.324 mil or 1.324 million from a consensus of 1.4. So that tells me that the housing market is struggling a little bit right now, especially on the starts and permit side. I haven't seen the recent resale ones, but it's just something to keep an eye on.
Yeah, I agree.
Now, I'm sure having the yields jack up 0.6, 0.8% all in a week's time didn't help.
We talked about this. Unless the home builders are self-financing, they are not going to be at any time record highs in housing sales.
No, absolutely not. So let me talk a little bit about an article that I was reading this morning. And so this is in the Investors Business Daily, talking about three markets that are doing well around the world. So this is the article is these countries' stock markets are racing ahead of the United States. And it's interesting. It's places that I wouldn't necessarily think would be. And Ron and I talked offline about this, and we were like, okay, I don't get it. Poland, Spain, Germany, I get, and Brazil.
I don't understand Brazil unless it's energy.
It's not that, it's natural resources. And I think especially with China talking about we're just not going to send rare earth minerals and stuff like that, there are places like Brazil that do have rare earth minerals that we could actually buy from. So that may increase it. The interesting thing on Poland, and this was the one where I was like, I don't really get it, but I looked into it more. The interesting thing on Poland is that Poland actually has become a major center for companies like Alphabet to come in and they're signing deals to develop AI in Poland. There's a lot of really smart people in a lot of those former Eastern Bloc countries, and it's a cheap place to live. And it's interesting that you're seeing kind of high tech happening in those markets. So it's made me look at, okay, maybe that's worth taking a little second look at when we look at the First Trust Stocks European Select Dividend Fund, so this is the FDD fund, you can see it went off the rails when we had the drop on tariff day, but it's actually recovered and it's doing extremely well. So it's made me say, I've not had a big sleeve or almost any sleeve in the international markets for a while.
Neither have I.
Is this going to continue, or is this just there was no other alternative in the United States? I think the other piece of this is we've also seen a massive change in the dollar during this time period. So, in dollar denominated standpoint, whether the market's doing well or not, it's going to look better from that perspective. What are your thoughts, Ron?
I think it's a no touch. Like I said, you know why? Because it's funny. I listened to a presentation 2 months ago, I guess it was, and they were talking about how people have just shied away from any international investing.
Yeah,
And because over the last 5, 10 years, whatever you want to look at,
it's been terrible.
The US is outperformed,
Yeah.
and a lot of the rest of the world, whether it's emerging markets or not, have been basically flat to negative. So
Mm.
my whole point is that, okay, great, yes, they've recovered, they've done well, but the other thing too is that each of those European countries, if you remember, we had talked about this a long time ago. You have the Northern Europeans and the Southern. The Northern
Yep.
Europeans are the workers. The Southern European people are the vacationers, the hospitality
Siesters.
people. So they're the lazy. Well, I want to say the lazy ones. They're the ones that, hey, manana, manana,
Yeah.
and that's the way they've been. My point is that I don't even know how you invested that. Not only that too, but their accounting standards. This is why I would never invest in China.
No.
Can't believe any of their accounting numbers.
Nope.
And unless you're a trader, right? It's not quote unquote a long-term investable asset. And with
Mm.
everything going on, how do you now say, yeah, I'm going to pick this country or this continent or this market because they're going to be the winner?
Yeah.
We don't know. We
Nope.
don't know.
No. Oh, I totally agree with you. Like I said, this was just it was looking at, wow, there is still green shoots in the world. And I think it's intriguing. It makes me take a second look at it. That does not mean that I'm ready to dump into it and say, hey, this is going to be the greatest place ever to invest. But it's intriguing to me to see then how as some of these trade agreements get worked out, how that changes. It does capital flow back to the United States more. I think this has been more of, hey, capital's flowing out of the United States going to these European markets, and capital is neither created nor destroyed. It just moves around.
And I think Europe will actually end up doing pretty good. Whether
Hmm.
I don't think they're going to do better than the US, but I think they'll do pretty good once the Russian-Ukraine war ends
I think
because
it's a
they're going to
biggie.
need a rebuild. And who's going to supply them with all that?
Yep,
Obviously the US, but shorter transportation costs from the other European countries.
absolutely.
So they're going to do well.
Yeah.
Who knows when that's going to end? And I have a feeling Ukraine's going to get the short end of the stick, but
I have a
who
feeling that,
knows?
if I think in the end you look at the areas that Putin wants, and it's all that land bridge area that goes into the Crimea, and he ain't going to give any of that up at this point.
The lithium, I understand, is huge there. Take a look at the
Yep.
lithium LIT ETF, and there's other things. I agree with you. That my point is that right now, I just think people just need to take a deep breath, live their lives, not worry so much because I don't think anything's going to happen or be decided in the short term.
No,
Period.
and I would say the back half of the year, if most of this stuff gets worked out, the tariff stuff, the tax stuff, I think the back half of the year and the next couple of years are going to be pretty outstanding. But it's going to take time, and a lot of these companies are not going to be able to pivot and get all this stuff done quickly. The president can pivot fast, but these companies can't pivot that fast, and so they're going to really have to have something in place to say, okay, we want you to get this working here in the United States. We'll give you time to do that and everything else.
And the two job functions that are working overtime and they are frothing at the mouth because this is their Super Bowl are economists and market strategists of the big investment banks, hedge funds, private equity, because they're trying to do all the gaming out scenarios
Yep.
with all the computers, algorithms, and AI. They're going to keep doing these inputs about where do we put the money? How do we game this out? If this happens, what does it affect us in short, medium, and long term? Believe me, this is their Super Bowl right now because they don't know. So all the gaming
Yeah.
out of this is what they're, I don't want to say
Not to
enjoying, but this
mention
is their
them,
job.
not to mention them adjusting their market targets every 3 weeks up or
A
down.
few more just got changed. We'll have to do it again next month to see how many more changed. And by the way, and here's the other thing. So more are updating. Actually, there's still one over 7,000, by the way,
Yep.
on the S&P. But even after they update it, here's the other interesting thing. Come July, first month of the second half of the year, if more of these trade things have been settled, again, all the gaming out has been done. They're going to change it again.
They're going to pop them up again. Oh, yeah. By the end of the year, look at what we told you it was going to be. Yeah. Now we've changed it 6 times during the year. So basically, your estimates are completely useless and your predictions are completely useless. Once again, I do not change mine. It is what
No.
it is. I'll be right or wrong at the end of the year. And I was almost right last year, pretty close, almost on the number. I'll call it a win at that point.
I think if you're within 10%, you're okay.
All right, we'll call it that.
What is it? You're close. It's close enough for what? Hand grenades and what?
Hand grenades and horseshoes there, buddy.
Horseshoes. There it is. Yes, yes.
That's the only
you know
thing
what?
close
We can
enough is
probably
good
do
for.
better with those two than they can with their
Yes,
numbers.
they can with it, their numbers and their estimates. Folks, thanks for joining us. Hopefully you enjoyed this. Hopefully you laughed a little bit along with us, because sometimes it's hard to laugh when the market's moving around like it is. So go outside, look up, make sure the sky is still blue and it's up there, and you'll know you can move on to the next day. We're here for you. We'll keep giving you this information as it comes. So thanks a lot, and we'll see you back here the very next time.